Hey, I'm back. Now, some of you have been asking me to explain why it is that higher interest rates are bearish for a currency and why lower interest rates are bullish for a currency, because it kind of sounds counterintuitive, and most likely most of you were brought up on the belief that rising rates are bullish for the currency and that falling rates are bearish, but that's not the way it works. Let's start off with just kind of a basic definition of money. It's a unit of exchange, and we define its value by its purchasing power. So if some unit of currency, a dollar, let's say, can buy a certain amount of goods and services, that defines its value. Now, if that dollar can now afford to purchase less of those goods and services, we say that the value of that dollar has gone down, and vice versa. If that unit of currency can now purchase a greater sized basket of goods and services, we say the value of that currency has gone up, right? So now let's move to the interest rate part. The interest rate is a price. It is a price set by the government, by the central bank. That's the government's bank. And it is the most important price in the economy. It's the price of credit, and all other prices reflect off of that. So when the central bank raises interest rates, all other prices in the economy tend to follow, because raising the cost of credit raises the cost of production. Producers tend to want to recoup that. They price their goods higher, and therefore you tend to get an inflationary effect. As a result, it is reflected in the exchange rate as the currency going down in value, because if the inflation rate goes up, that's another way of saying you get less for your money, okay? You get a smaller basket of goods and services. The exchange rate adjusts down, and vice versa. When you cut the interest rate, that's like lowering prices across the entire economy, which is another way of saying you get more for your money, and it is reflected in the exchange rate of the currency as the currency going up in value. That's the way it works. Most people don't understand that, so they see the price, the interest rate going up, and they buy the currency because there's this kind of belief that capital flows will then flow to that currency. That may be at the margin a very small factor, okay? But the real thing that's going on here is a price adjustment. Increasing prices mean a lower value for the currency. You get less for your money, and so it's reflected that way in exchange rate terms. Decreasing prices means that unit of currency has greater purchasing power, and therefore it rises. Now, that's not to say the initial reaction isn't going to be the opposite, but we know when the clueless, uneducated, misinformed gang does their thing, we wait patiently like tigers, ready to pounce. And when that whole portfolio shift happens, we go the other way, and they're all sitting there scratching their heads. That's why when, from 2008 on, when the Fed brought interest rates down to zero, the initial reaction was the dollar went down, but then it went up for 8 years, for 7 years. All the idiots, they kept talking about a dollar crash, and it kept going up. And then when the Fed raised the rate last December, the dollar peaked down, and it's been going down, and they're still scratching their heads. They don't understand it. They just say the dollar's going to crash all the time. Okay, that's the fear card. I talked about it in my last video. Anyway, that's the way it works. There's some more to it, but in general, that's the way it works. I hope that helps.